Hello everyone. Welcome back to my channel, The Cheryl Hubbard Show. So glad you can join me. Glad to see you. Glad you can be here. So I just want to do a little review. Let's do a little review of a few debits and credits. But first, let's go over some terms. So in other words, when it comes to accounting. Now, see, when I was at Australia University, I was kind of, when I first found out that I had to take an accounting course, I was, and then when the teacher, you know, when we started getting into our book and the teacher was introducing T accounts, so T accounts, I was kind of like, what is that, So I was kind of leery of that, but once I got into it and, put my mind to it and kept on, studying and getting in the book. A lot of times when you're in college, people might say, well, college is, it's not for me, it's hard. But it's not that hard sometimes, depending on, I guess, the subjects that you're taking. But if you get into that book and you study, because I found that a lot of times I had to, I had to go over the chapter, like, I had to read through the chapter, like, more than once. The teacher might say, hey, read chapter 4, 5, and 6. So you might think, hey, you know what, I read it once and, it'll be good, it'll sink in and all that. But sometimes I found myself having to read, if I had chapters 3, 4, 5, and 6, or 1, 2, 3, or whatever chapters the teacher told me to read, sometimes I found that I had to read, those chapters more than once because you had to make it sink in. And a lot of times at Australia University, we had a lot of open book tests. But then some of the students in my class, they were like, I ain't worried about studying because we're going to have an open book test. I said, yeah, okay. Well, I still went on to study because a lot of times they can be open book, but sometimes those answers and those answers or whatever, to those questions, or you might have to write a paragraph or a couple paragraphs, or sometimes it's hard to find what you're looking for if you just you're just relying on, oh, I'm gonna get through this book. I can find, what I'm looking for. But sometimes just because it's open book doesn't make it easy. So when we had tests, and I knew that we were going to have tests, whether it was accounting, whether it was a test for my accounting course, one of my accounting courses, one of my business courses, one of my computer courses, I always made sure I studied. So today I just want to go over a few little debits and credits, and then I have some other things to read in the book. So first of all, let's go over some of the terms. Now, what we did when I first started taking accounting, well, the first thing we did in the book, the teacher had us go over some terms because he knew that the terms were going to be important to us. So in other words, when we got to the T accounts, we'll know these terms right here, and he knew that these terms right here were very important to us. They were going to be important to us when it comes to our T accounts, and we had to balance checkbooks. We had to balance the checkbook. I think we did T accounts. We learned a whole lot of different terms, assets, liabilities, owner's equity, accounts receivables, accounts payables. So a lot of people may say, well, why learn accounting? Accounting is good. I think everybody should learn accounting because we all have to pay bills. We all have bank accounts. And we all, in our day-to-day lives, we are dealing with various transactions. You're buying a house, you're buying a car, you're buying clothes, you're going shopping, you may be running a business. So you may be running a business. And my first transaction in the book that I learned, was Gary Line when he invested $50,000 in the business. So he invested $50,000 in the business, so that becomes equity. So if you invested $50,000 in the business, I would debit cash $50,000 and credit owner's equity $50,000. So $50,000 becomes equity in the business. So first, let's just start out with terms. First term I have is the assets. Assets, if you have an asset can be machinery. In other words, you got mainframes, you got supercomputers, mini computers, microcomputers, assets, anything that can be converted into cash and can have a future value. So in other words, you buy a pair of tennis shoes, that wouldn't be no asset because they don't have those tennis shoes do not have a future value. So some people might say, hey, I'll go out here and buy me 10, 15, 20 pair of Jordans. They will have no value in the future. So we talking about buildings, land, uh, houses, buildings, land, houses. You may have computers, mainframe, supercomputers, mini computers, microcomputers. It has to have that future value. So that's what an asset is. Assets are those are some examples of assets. So here go the next one, liabilities. So liabilities are basically your debts. You have a liability. You have a electric bill. You have a water bill, gas bill. You have to pay rent. Those are all liabilities. Owner's equity, I just explained. In other words, say for instance, I have my business, Shirley Cosmetics, and I invested $100,000 in my business. I invested $100,000 in my business. So what I want to do is say that will be, I will debit my cash account, and I want to credit my owner's equity account. That's my business, Shirley Cosmetics. So that would be my equity in the business. Then we have accounts receivables. In other words, you run in a business and somebody come in your store or your establishment and they want to purchase something. Maybe they want to purchase, you run in other words, Shirley Cosmetics. They want to purchase $5,000 worth of my cosmetic supplies, my makeup, my lip glosses, my body butter, and my hair growth oil that I'll be marketing. So they want to purchase some of those things, but they're not gonna pay right on, all at one time. So they want to create an accounts receivable. So initially they would create accounts payable because they're gonna have to pay the company. But when you as a company, when you receive funds from them, you're creating accounts receivable. In other words, somebody buy $5,000 worth of, like I said, Shirley Cosmetics, and they paid 5,000. Well, they agreed to pay 5,000, but maybe they put a down payment and they didn't pay it all at one time. So, excuse me, when they start paying the company back, you can put it down as accounts receivable. So when they create accounts payable, you can put it on your books as an accounts receivable, but on their books they would probably put it down as accounts payable because they're gonna know they're gonna have to pay. They're gonna have to pay the company. And then also a notes receivable, that's when you write, that's like a promissory note. So somebody promises to pay your company, say for instance my company, Shirley Cosmetics, 5,000. So we wrote it down. I wrote it down as I wrote it down on a promissory note for them to sign, and they promised to pay my company the $5,000 that I lent them that credit. I lent them the credit, so they will have to pay. And then we have revenues. Your revenues are your earned. In other words, you go out there and say, for instance, somebody come into my company and I need some painting done, and they would be creating revenue if they come and paint my place. They paint my place of business. I have certain square foot and certain square feet, and they come and paint my business. So I would have to pay them. They would be creating revenue. But if I go out and I want to create revenue, in other words, I go out and create, say for instance, I went out there and did some work, I went out there and did some landscaping, and I could have done some painting, I could have done, a number of things, and I will be creating revenue. So revenues are your money earned. Okay, so you have your service revenue, interest revenue. So in other words, if say for instance I could if I owned a hair salon and I did 8 or 9 ladies' hair, gentlemen's hair, I'm creating service revenue. bringing back money to my salon. So these are just a couple little terms. So the terms like these are the terms that I learned rather, in the beginning of my accounting, uh, the beginning of my accounting course. So I was kind of leery of accounting when I first started it, but I was like, it's kind of interesting. But I think everybody should learn accounting because, at least just know the basics. Learn your basic debits and credits. So when you learn your debits and credits, and I'll let this dry for a little bit. So you learn your debits and credits, and then you know what account, what T account. So in other words, we have a T account. We might have a cash T account. We have what's that? Accounts receivable. We have accounts receivable T account. Accounts payable T account. We also have expenses. You have your expenses T account. In other words, your rent, your electric. You might have to pay a phone bill. You might have to pay rent. Those will be under your expenses account. And we also have a depreciation account, a T account. In other words, if you buy, say for instance, you buy this building, you buy a building and it's worth $50,000. How much is it going to depreciate over a 5-year period or over a 10-year period? So it's a calculation for that. One calculating method is called the straight line method. So I'll probably do that. I think I went back. I know I have a video on the straight line method on my channel. So, but I'm not gonna go over that right now. But so in other words, you bought a building. How much is it going to depreciate every year? Up to 5 years. So that way, that building or that land, that building, that car, that house will not be worth what you paid for in the beginning. In other words, it won't be worth what you paid for 5 years from now. Even a year from now, you bought a building for $100,000, $50,000. Then a year later, it won't be worth that. It'll be depreciated by a year. So it's a straight line method. Then there's a couple other methods too that's in the book. So I'll probably go over those at a later date. But I know I do have a video on that straight line method. So let's start out with the simplest transaction that I learned when I first started accounting. And Gary Line invested $50,000 in the business. But what I'm gonna do it different this time. That's with my company, Shirley Cosmetics. Shirley Cosmetics. So say for instance I invested let's go with $100,000. So usually when I do my transactions, they always say that each transaction affects 2 accounts. So I invested $100,000 in my business. So I want to debit my cash account $100,000, and then I want to credit owner's equity $100,000. I want to debit cash $100,000 because when it comes to an asset account, you debit on the left for increase. So since I'm gaining an asset, I'm increasing. I'm increasing my cash account. Cash account is an asset account. So I just mentioned some of the assets, when I was going over the terms. So remember I said you have an asset, anything that can bring value anything that has future value. So in other words, you have buildings, you have land, you have cash, even owner's equity will still be an asset. So I debit my cash account $100,000. That increases my cash. That increases my asset account. And I want to credit my owner's equity, owner's equity $100,000. So that gives me $100,000 worth of equity in my business. So let's see. So then what if I In other words, I invested 100,000. I invested 100,000 in my business and Shirley Cosmetics, and now I want to purchase some supplies. So I want to purchase some supplies. So the board is a little wet right now, but so I invested 100,000 in my business, and now Shirley Cosmetics. Now I need some lip gloss tubes. I need oils. I need some oils. I need some castor oil. I need some vitamin E oil. I need some lavender oils. I need some tea tree oils. I need various oils, and I need some butters. I need shea butter. I need some cocoa butter and some mango butter. So I need those butters so I can mix them with my oils, so I can make my lip glosses, and I can also make my body butters and my hair growth oil. So what I want to do, since I said I want to buy some supplies, so let's go with supplies. So when I purchase supplies is an asset. So I just mentioned that when it comes to an asset account, you debit on the left for increase. So since I'm going to purchase supplies, I'm increasing my asset account supplies. So say for instance, I just invested 100,000 in my business, but I just need $10,000 worth of supplies. I want to purchase $10,000 worth of supplies. So it's going to have to come out my cash account. So you remember previously in the previous transaction, I added. Actually, I added 100,000. Basically, I invested 100,000. So let's put this back over here. This is the 100,000 that I invested in the previous transaction. So I invested 100,000 in my business. So that went into my cash account. So I want to debit my cash on the left, but now I want to purchase these supplies. So when it comes to an asset account, you want to credit on the right or decrease. So I want to take $10,000. I'm taking $10,000 out of my cash account, purchase my supplies. So when I take $10,000 out of my cash account to purchase my supplies, then that's going to leave me, what's that, 90,000? That's going to leave me $90,000. 90,000, because see, you took 10,000 away from your 100,000. So we credit cash 10,000. So with an asset account, you credit on the right for a decrease. So we're decreasing because we're taking out 10,000 for supplies. 10,000 for supplies. And also we can create an account for withdrawals. So a lot of times when you withdraw money out of the cash account, you create another account for withdrawals. So we're taking 10,000 out. Taking 10,000 out for our supplies. So that's how that one goes. So I'm not an expert in accounting, but I took a few accounting courses, so I just want to refresh my memory as well. So let me see. Let me try one. Let me do one for let's do a couple. These are just a couple of simple ones. And also, when it comes to in other words, when you're doing with somebody, you have somebody working in the accounting department. What they would do, I mean, I never been an accountant, but they do have to do the income statements, the balance sheets, and your statement of owner's equity or statement of cash flows. Statement of cash flows is a statement that basically displays all the cash coming in to your company and the cash going out of your company. And then you have your income statement, revenues minus your expenses. So you have your revenues. What revenues do you have for that accounting cycle? add all your revenue, or add all your revenues up, minus your expenses, and that will give you your net income. And then you have your balance sheet. Assets equals liabilities plus owner's equity. So you take all your assets, like I said, your buildings, your land, whatever assets you have for your business. You take your assets, and they're supposed to equal. See, this is initial accounting equation. Assets equals liabilities plus owner's equity. That is the initial accounting equation, and also this is what goes on the balance sheet. That's what goes on the balance sheet. Assets equals liabilities plus owner's equity. So all of these documents will, at the end of the accounting cycle, so you have somebody that deals with the, somebody working in the accounting department. You might have a CPA, certified public accountant, or you might just have a public accountant, or whomever you have working in your accounting department. You will have, they will deal with your, make sure these documents are, because for one thing, when it comes to financial accounting, these documents have to be accurate. Accounting records have to be accurate. So, because you have your auditors, your creditors, your SEC, Securities and Exchange Commission, you have those people that, when it comes to financial accounting, those documents have to be done, and they have to be accurate. So, say for instance, your company want to borrow some money, or your company want to purchase some vehicles. You run in a daycare center, you want to purchase some vehicles to transport the kids around. You have to have your paperwork in order, because you might want to get a loan. You might need a loan to purchase those vehicles. They are going to want to know, how is this company doing? How is this company doing, and can they pay us our money back? So that's what they want to know. So they will be looking at your balance sheets, your revenue, your balance sheets, your income statements. Yeah, your revenues minus expenses, which is your income statement, and your statement of cash flows. What type of money do they have coming in? What type of money do they have going out? So then you have managerial accounting. So we have financial accounting, managerial accounting, and managerial accounting is not mandatory. But I think it's still a good idea to do. For managers, have to keep up with the books within a corporation or within an organization. So managers need to know too how the company is doing, so they know how to move forward. What are we going to be doing 5 years from now? How are we going to succeed in the future? What is our mission statement? What are our long-term goals for our company? Things like that. So, just got off a little track a little bit, but that's how that is. But when I first started taking accounting, I was a little nervous, but I can honestly say to you all today that I love me some accounting. I really do. But what I want to do is probably, just keep on working on my accounting. I sure would like to. I mean, I took managerial accounting too. I took managerial accounting, and I took regular accounting, because Australia University, those were the two requirements, managerial, and then the first one was basic accounting, and I had two good teachers down there. And then I had two good teachers. So let me do a couple more T accounts. Let me see. I think I want to do one. Okay, let's do one. In other words, let's go with another company. Say for instance, I'm running a nail salon. I do hair, I do nails, I do manicures, pedicures, and I need to go out somewhere and purchase. I want to purchase something on credit. I need to go purchase my supplies, and I want to purchase them on credit. So let's start out with two T accounts. I need to buy some inventory. So say for instance, I need to go and buy. I don't need a whole lot. Maybe about $5,000. I need to buy $5,000 worth of inventory. Yeah, like I said, I need, I'm running a hair nail salon. I need probably different color nail polishes. I need, I need some more, stuff so I can fix the people's, my customers. I need to fix their eyebrows, eyelashes. I need different color nail polish. So I want to buy it on credit. I want to buy all my supplies on credit. So I want to create, that would be a liability, but I want to create accounts payable. I want to go to this company, I want to buy these products, and I'm going to create accounts payable because I'm not going to pay, I don't want to pay for it all at one time. I want to create accounts payable and a notes payable. So accounts payable, so when I create accounts payable, I want to credit accounts payable. Say for instance, I just need $2,000. I will create accounts payable $2,000 because I want to buy some inventory. So I want to debit. Since inventory is an asset account, as I said previously, you want to debit on the left for asset account. When you want to increase an asset account, you debit on the left. So when I'm creating accounts payable, so I want to credit that account payable for $2,000. See, so I'm increasing my accounts payable account. So that's why when it comes to a liability, you want to increase on the right hand side, which is a credit. See, we have debit on the left and credit on the right. Debit on the left, credit on the right. But this is an asset account. Inventory is an asset account. So when it comes to an asset account, you debit on the left for increase. And then accounts payable is a liabilities account. So we want to credit on the right for increase. We credit on the right for increase. Now when we start paying, in other words, I created accounts payable for $2,000, but if I did a notes payable and I wrote it down, it would be the same thing. If I want to create a notes payable, I create a what they call a promissory note. I would sign a promissory note, and I create a notes payable. That means it's written down as a promissory note. That means you promise to pay. And basically, accounts payable is a promise to pay as well. And so, like I said, if I initially started my accounts payable with $2,000, I created it. Now I owe $2,000 to this company that I bought all these supplies for my inventory for my hair and nail salon. But when I start paying it back, I go on here to the left side to the debit. Say for instance, I take the $2,000 and I want to pay that. I want to pay that back. This is the money that I created with my accounts payable. So what I do, I debit on the left hand side, and also I had to create a T account for cash. It could be a cash. I would think it would be cash. In other words, I could take the $2,000 out of my cash account so I can pay my accounts payable off. So if it's coming out the cash account, it's going to be a credit to cash, $2,000. And also, it's a withdrawals account. It could have been a withdrawals account. A withdrawal account, I would debit. If I want to take $2,000 out of my withdrawals account, I would debit my withdrawals account on the left-hand side. So you just have to kind of distinguish which two accounts it affects. It's going to affect two accounts, but sometimes it does affect three accounts. And they call that, I think they call it a double entry. I believe it's called a double entry, but it's in a book. So let me see what other one. Okay, I did supplies. Okay, let me do an expenses. Let me do one more. And say for instance you have okay, in other words you have and you have some employees to pay. In other words, you are a manager, supervisor, and you have you have your employees to pay. So you have what they call you have it would be coming out of the expense account for the company. In other words, you have your expenses, you have to pay your employees, you have to pay your rent, your electric, whatever bills you have to pay. So in other words, if you have a company that you are running and you have to pay you know, you have to pay your employees. So we're going to create a salary that will come under salaries expenses. So you have a salary expenses account. Say for instance you have 5 employees that you want to pay, and you know each of them. Say for instance this is a salaries expense. So we have employees. We have 5 employees, and each of them, you know, they got different amounts. You got $2,000. You had to pay one employee. $3,000. 1,000. You owe another employee. 6,000. 8,000. So this comes under your salary expenses. You have to pay your employees. 5 employees. So since you have to pay those employees, it still can come out your business account. It can come out your cash. So that means you debit on the right-hand side, because you have to pay. So you know what I said, an asset account, you debit on the left for increase, but since we're decreasing the asset account, which is cash, we want to credit on the right-hand side. So we have to pay these employees $6,000 and $8,000. So that's that one. And I'll probably do another review, maybe tomorrow. Okay, let's see what other one. Okay. We're at 30-something minutes. Okay. Okay, let me see some transactions in the book. Let me see what transactions I have in the book. Okay, let's see. Let's see some transactions in the book. Okay, I have, we have, see, this is the initial transaction. This is the same book that when I was downstairs at university, this is the book that we had, accounting, same book. See, same old book. Okay, and this is the initial first transaction. Gary Line invested $50,000 in the business. So he deposited $50,000 in the business bank account, and so there was a debit to the cash account, which is an asset, and credit owner's equity. Owner's equity account is also called the capital account. And then he wanted to purchase some land. So let's see how that one would look. So Gary Line, he purchased. Actually, he started his business with $50,000. And then this came with the owner's equity account. So $50,000, and then owner's equity $50,000. This is the same. That's sort of the same initial problem that I was going over. In other words, Gary Line invested $50,000 in his business. So as I said previously, when you increase your asset account cash, it will be a debit to the left. So if I want to decrease my cash account, I will credit on the right. So in other words, if I want to decrease my cash account, I want to credit on the right. So in other words, he invested $50,000 in the business, so that gives him $50,000 asset. Cash would be an asset, and also owner's equity. So we want to credit owner's equity because that increases the owner. This is the equity that he would have in his business. Say for instance, he wanted to buy, and if he invested $50,000 in the business, but he wanted to take $10,000 out and buy some supplies for the business. Say for instance, $20,000. We want to credit cash $20,000 because debit credit. We want to credit $20,000 because it would be a decrease, but we want to debit So you always have the debit on the left and credits on the right. And debits on the left, credits on the right for every T account. So you don't have to mix them up and say we're debit, but debit on the left, credit on the right. You just have to figure out which two accounts are going to be affected. They're going to be affected. Yep, so which two accounts are going to be affected. So in other words, he invested $50,000 in the business. He got $50,000 in equity. He took out $20,000 for some inventory. So if you took out $20,000 for inventory, then we'll come over here and it would be $30,000 left. See, so remember that the rules that I learned is that whatever side you increase your T account on, that's the side you put your balance on. So he invested $50,000 in his business. He purchased $20,000 in supplies. So that give him $30,000 left, and $30,000 will be your balance. And also, since he took out $20,000, you have to create a withdrawals account. You have to create a withdrawals account. So, and that would be a debit on the left hand side for $20,000. So he took $20,000 out. He withdrew $20,000 and bought some supplies. So credit cash $20,000 for the supplies, $20,000 debit withdrawals account. So this is debit and credit. Debit the withdrawals account for $20,000, and then that would also bring owner's equity down. You also would have to come over here and take $20,000 out to owner's equity, and then so you still will have your $30,000 in your owner's equity. You have $30,000 owner's equity, so you still have to take $20,000 out your owner's equity, $20,000 on your withdrawals account, and you credit your cash. It came out your cash account, $20,000. So that is that one. So very interesting, these accounting problems. So let's see. I think that's the last one I want to do on that one. I think. So let me see. Is that the last one I want to do? Yeah, I did a liabilities. I did supplies. I did supplies. So let me see what other problems in the book. So also we have let's see. Oh, we did the land. Oh, I didn't do the land. Okay, let's do the land. This will be the last one. In other words, see, I did a couple of videos, I believe, on depreciation. So a lot of times when when you buy land, you buy a building, you buy a car, then you have to allow for depreciation. That's why when you purchase a car, you can't sell it for, in other words, 2-3 years down the line, you can't sell it for what you purchased it for because depreciation. So in other words, my company, Shirley Cosmetics, I want to purchase some land because I want to put another building on this land so I can, increase my my business equity. I want to increase my holdings, my customers. I just want to increase my overall business. I want to expand. So I purchased some land, and land is an asset. As I said, land, building, machinery, equipment, cash, accounts receivables. All those will come under your asset. They will be included in your asset accounts. So in other words, for my company, I want to purchase some land, and I invested $100,000 in my business, so I don't want to go overboard. I had that in my previous transaction. I invested $100,000 in my business, but now I want to take $30,000. I want to purchase some land for $30,000. So see, since land is an asset account, I want to debit on the left. See, debit, credit on the left, debit and credit. So I purchased land for $30,000. So that comes out of my $100,000, my initial investment. I invested $50,000 in Shirley Cosmetics. So I started my business. I had $100,000. I invested in my business, and so they give me $100,000 in equity. So I purchased some land because I want, like I said, expand. I want to do things on this land to expand my business. I want to build, I want to hire more employees. I want to increase my inventory. I want to increase my product line. I just want to expand my business. So 30,000 in land. Land is an asset, so I want to debit on the left. And so, what would be my next transaction? I always say you got two transactions. So land, I would So in other words, if I purchase land for 30,000, I guess that would affect the cash account too as well. So you always have to think about what two accounts it will affect. So land 30,000. So I want to take 30,000, but it can also come out my owner's equity. But it's still gonna come out my owner's equity. But anyway, so I guess it'll come out my cash. So I want to credit. Since it's gonna be a decrease in my cash account, I want to credit. I don't want to debit. I want to credit, because credit for decrease, debit for increase. But I want to decrease, so I'm taking out 30,000 to purchase this land. See, so I'm gonna credit my cash account 30,000, and I want to debit my land account 30,000. So there you have it. So I think those are the only two accounts that it affects. Oh, and also definitely still probably affects the owner's equity account. So owner's equity would come on this side. I would put 30,000 over here. I would debit owner's equity 30,000. So I'm not increasing my owner's equity this time. Like with my initial investment, 100,000, I would credit owner's equity for an increase. But this is a decrease, so I want to debit owner's equity for decrease. So this is a debit, and sometimes it is confusing. You got to know which side is for decrease and which side is for increase. And that's what I had trouble with when I first started accounting. But you just have to practice. Just have to practice and know your debits and credits, and know what an asset is, what a liability, what is considered a liability, what is considered an asset, what is an accounts receivable, accounts payables, accounts receivable. I probably could have been a CPA. Really? Really, y'all? But, I got to get down in my accounting. I still need to review, and I want to learn some of it, I still want to learn more accounting, then you can also, they do this on, they do accounting on spreadsheets. I didn't learn all that. I didn't do all that. Maybe I can get into that. So, okay, so I think I'm going to leave it right here. Just wanted to review a little bit of accounting for y'all today. So how did you, you love that? How did you like that? So just want to do a little review. All right, so there you have it. So let me see what's in the book. Okay, so we talked about land. So in other words, I purchased the company, they purchased some land. Okay, so okay, let's talk about let's just talk a little bit about here goes a few little transactions. I can do a few let me see. First of all, let's just review what goes on. In other words, the balance sheet. So in other words, we have a balance sheet, and we have what did I say? Income statement. I said a balance sheet, then I have an income statement. So a balance sheet, the initial equation is assets equals liabilities plus owner's equity. So assets equals liabilities plus owner's equity. Assets equals liabilities plus owner's equity. So that goes on the balance sheet. So in other words, your accountant, or even you might not even have an accountant. I mean, depending on how big your business is. Some people don't even have some people don't even have an accounting department, so they might just have somebody that they you know that they designated, I guess I would say, that they designated to do their accounting books. And sometimes you run in a company, a lot of people do their own accounting. I say, I'm quite sure I can do my own accounting. But I mean, if I had a big company now, if I had the money, if I was a big time millionaire and I had a big several businesses, I probably would hire an accountant, you know. And but just to run a small company, I'm quite sure I can, have my own books. Uh, and then we have an income statement, revenues minus expenses. So all your revenues, your service revenues, whatever revenues you have, you working, you did some work and you made some money. That's what revenue is. And that goes on to the income statement. Revenues minus your expenses. What expenses do you have? My revenues. I have service revenue. I'm running a barber shop, or I'm running a hair salon, nail salon. I made $50,000 in revenue by doing hair and nails, cutting hair, barbering, cutting hair, and then those would be including my revenue, and then I would minus off my expenses. My expenses, I may have to pay my employees. I have to pay rent, electric. I have overhead, depreciation. Overhead. I have a warehouse and where I keep my supplies. I have to pay overhead. You know, everything that is not directly linked to the product will be considered overhead. You know, so I'll get into those terms. I think I have a video too I did on that. On the I think that came up. I think those terms came when I was doing my managerial accounting, where we were talking about uh, indirect materials, direct materials. That came under my. We talked about overhead, direct materials, and indirect materials. You still had your expenses, so anything that wasn't directly linked to the product, the making of the product, because you have your materials, direct materials, indirect materials. You had to, when you're making a product, you're manufacturing, you're running a manufacturing company. So that is a whole another set of terms for managerial accounting. So, you run a manufacturing firm, and those, dealing with materials, and we have a working process. In other words, you're working on a product, you're working on, say for instance, you sewing. You have a manufacturing company and you're making dolls and you need to sew them. But you're making jeans, you need to put those together. So, but they may be a working process. They might not be finished. So it's a whole set of, I might do another tutorial on those terms too. So income statement, revenues minus expenses, all your revenues, add them all up for that particular accounting cycle, and minus your expenses, and that will give you your net income. That's going to give you your net income. So I think I'm going to wrap this up for right now. So accounting it's just something that you have to work at. So I need to work more on my accounting too, but I need to work more on my accounting too, but so let me see what is. So there we have so in other words, then they said look, Smith invests $35,000 in his business. So he invests $35,000. I want to debit cash $35,000 and credit on his equity $35,000. So then another one, she purchases an account office supplies costing $350. So she purchased office supplies for $350. I want to she purchased office supplies, so that would be a debit to office supplies $350, and I want to credit accounts payable because she bought them on account. $350 for office supplies on account. So that would be accounts payable, $350, and debit office supplies, $350, because office supplies is an asset and you are gaining an asset, which is supplies, which are supplies. Always have a singular subject, singular verb, plural subject, plural verb. So subject and verb agreement. So supplies are. So supplies are. So just getting into English too. Really. But and here's another one right here. Smith pays $30,000 in cash to acquire a lot next to the campus. Okay, let's see how we would do that one. She intends to use the land as a future building site for her business office. $30,000 cash for land, for a lot next to the campus. Okay, she paid $30,000. I always say start out with two. She paid $30,000 for a lot. It don't say it was land. It just say a lot. She paid $30,000 to acquire a lot next to the campus. Oh, okay, it's land. Okay, yeah. So it's considered land. She paid $30,000. I think I went over one just like this. She paid $30,000 for a lot of land near her campus. So land, I would do $30,000, and then it would be cash. Since it's coming out of the cash account, I want to credit cash $30,000. So in other words, land is an asset, so we debit on the left, credit, debit, and credit. So in other words, land $30,000. We increase our land account, we increase an asset. We want to debit that on the left, or debit an asset account for increase on the left, and credit cash. Since it came out the cash account, we want to credit cash $30,000. So when you're dealing in your bank accounts, it's totally different. When it comes to accounting, it's a credit for increase. No, credit for decrease. It's a credit for decrease. Don't want to get confused. So it's a credit for decrease when it comes to the cash account in accounting. But in other words, you have a bank account, and you're the manager of that bank. Say, well, we're gonna put a credit on your account. So a credit, in that sense, they want to credit your account. In other words, they owe you some money. There would be an increase. But that would be a debit on the left for increase. But when it comes to accounting, see, it would be a credit. It would be a credit for a decrease. But when it comes to the real world, it's a credit for increase. See, it's like the opposite. So in other words, it comes out of the cash account. It's coming out of the cash account $30,000 because she purchased some land. She purchased land for $30,000. It cost $30,000, so you had to pay for the land. So the land becomes an asset. You want to debit your land account $30,000. So that's how they go. Yeah, so I think I'm gonna wrap that up right now. I'm getting a little tired, y'all. So let me see. Okay. In other words, and then they have different ones where you say 2,000. She paid 2,000. She paid 2,000 for personal funds for vacation. Actually, that is not an accounting. That is not an accounting transaction because you're not supposed to commingle your funds when it comes to accounting. When it comes to your books. So let's see. And this one right here. Well, I guess she took out. It says what's her name? Smith withdrew. This will be the last one. Smith withdrew $1,200. So I would have to definitely create a withdrawal account. Smith withdrew $1,200. Oh, yeah, right. Okay, $1,200. That's right. Excuse me. Smith withdrew $1,200. Smith withdrew $1,200. So I would debit my withdrawals account, and also since she withdrew $1,200, I want to credit. I want to credit my cash account $1,200. I have to be thinking. So can't be slipping. Yeah, because one wrong answer or whatever. You know, you can have a problem that may have 4 or 5 different answers, and one wrong, you know, answer could make the whole problem wrong. So, you know, that's how I go in accounting. So withdrawal, she withdrew 1,200 out of her cash account. So we want to credit. We want to credit the cash because this is going to be a decrease. So we debit and credit, but it's a credit for decrease. So 1,200 came out of the account, and also you have to take 1,200 out of the withdrawals account, which would be a debit to the withdrawals account. So, all right, I think I'm gonna wrap it up here. Okay, yes, and so I'll probably be doing some more reviews because I had a whole lot. Cause I did some. I started out doing some accounting tutorials. I know some of the videos might not be as clear, but I had you know, tried to, you know, increase my lighting. I'm gonna get some more lighting too. I want to make it brighter than this. I want to purchase me a nice pole lamp, you know. But, you know, it seems like it's pretty good lit up in here. I have a lamp on here and my big light here in the ceiling. But I do want to get some more lighting. I'll be probably getting other things for my channel. As my channel grows, I want to grow right with my channel. So, you know. Okay, let's see. See, I always have my little balloons in the background, but okay, so let's see what we have next. So, okay, I think that's it. Yeah, so in other words, we have Smith invested 35,000. We have Smith invested 35,000. Smith invested 35,000. I think to start his business. 35,000 to start the business. So, you know, we know that's gonna be cash. 35,000. 35,000 to start a business. So it's gonna be owner's equity 35,000. In other words, 35,000 to start the business. That gives him 35,000 in equity. So that's similar to what I already did. And I think the last one is paid $100 on account. Purchase $150 off the price. He paid $100 on account. So in other words, he paid $100 on account. Let's put this over here. Let's say we have a cash account. He paid $100 on account. So in other words, for him to pay $100 on account, he had to have created an accounts payable somewhere, somehow. So that's the accounts payable. So accounts payable, if he paid $100 on his account, that means I want to debit accounts payable because he paid it on the account. So usually when you first create an accounts payable, you're going to credit. You credit on the left for when you increase your accounts payable. So over here, since he paid $100 on the account, we want to take it out. We also want to take $100 out of the cash account. So we want to credit. We're going to credit the cash account. We're going to credit the cash account $100 because he took $100 out of the cash account and paid $100 on his accounts payable. So in other words, his accounts payable, in other words, he went somewhere and he purchased something on time. He didn't pay all of it at one time, so he may owe them $5,500, but he paid $100 on it. Paid $100 on it. But when you create your accounts payable, you want to credit on the right side. But when you pay it, when you start paying on it, it goes on the left as a debit. So that's how that goes. So Uh, that is it for that class. But then I want to just talk a little bit about let's see. Let's talk a little bit about let's just talk a little bit about let me see. I have a few of the things that I want to read about the coronavirus. So, the coronavirus is still lingering, but just a few things because I'm about to wrap it up because it's already about 1 hour. Yeah, so I was just reading on, actually I don't need these. I was reading on the computer earlier today about the coronavirus, and it's still, we're still ending up with cases, and yeah, we still ended up with cases, and what I found out today is that, they were saying that they didn't know why some people were affected harder, why the coronavirus affected some people harder than it affected others. But the reason they think is because the mutations are different. In other words, they said that it was a stronger strain. It might have been more than one strain of the virus, and that's why some people may it might the strain might affect some people differently because it was a different strain, a different strain of the virus. And it says a mutated form of the virus rapidly emerging over the month of March, becoming the dominant form. When viruses with this mutation enter a population, they rapidly begin to take over the local epidemic. So in other words, we already had an epidemic. If you already had an epidemic, hold my microphone. So if you already had an epidemic, and you already had an epidemic, and then you have another strain of the virus, so that will take over. And say new virus in the week of February, and by March 15th, the mutated strain dominated. So New York was hit by the original virus around March 15. Mutated strain dominated. So in other words, New York might have been hit by that stronger strain. That's why New York, because people were saying, well, maybe New York was bigger, the population is larger. But it say New York was hit by the original virus around March 15th, and that's when the mutated strain dominated. A mutant coronavirus more contagious than the original. So in other words, they are dealing with more than one strain of the virus. Probably that's why they're saying, well, this is just a study that they did. So this is a study that scientists did, and they are saying that it was another strain of the virus. So they said, in addition to spreading faster, it may make people vulnerable. This is talking about this second strain, second infection. In addition to spreading faster, it may make people vulnerable to a second infection after a first bout with the disease. So in other words, that second strain of the virus, it could still infect, in other words, the people that have been infected previously they run a risk of getting infected again with that, the other stronger strain of the coronavirus. It says, wherever the new strain appeared, it quickly infected far more people than the earlier strains that came out of Wuhan, China. The new strain's dominance over its predecessors demonstrates that it is more infectious, according to the report, and it's not known. And they had one called SARS-CoV-2 infected. SARS-CoV-2 infected 3.5 million people. 250,000 COVID-19 deaths. So they were just talking about it on the news too today, and I just happened to read over this earlier. That's how I wrote my notes. I wrote my notes because I read this on the computer today. And it says, then they have a team called LA Alamos, and they, out of Duke University, they identified 14 mutations These mutations occurred among the nearly 30,000 base pairs of RNA. I guess that's ribonucleic acid, because I learned that in one of my, I think I was taking, or actually I was taking a nursing course one time, RNA, ribonucleic acid. I think that's what that term, what you call it, abbreviation means. RNA that other scientists say make up the coronavirus's genome. So, mutation called D614G, responsible for the virus spike, responsible for the spike in the virus. A mutated form of the virus very rapidly emerging and over the month of March becoming the dominant pandemic form. So in other words, they're saying that according to their research, it's a different strain of virus that came about, and that's why some people are getting different. Some people don't have any symptoms at all. Some people are asymptomatic. Some people have harder symptoms than others, and some people test positive and didn't show any symptoms. So this, mutations. So that's why it's good to do your own research. Do your own research and read, And it say a team at LANL saw a massive global effort of clinical people and experimental groups. So that's they. And a matter of fact, on the news, I did see today that they had they were showing the people that they gave the trial. They running the trial on the vaccination. So they I think they I don't know what exact. Don't remember what the exact date is. I don't know if they started it yesterday or something. But they started the trial vaccination, and they have some people that's participating in the study. It says a massive global effort of clinical people and experimental groups who make new sequences of the viruses SARS-CoV-2 in their local communities available as quickly as they possibly can. Scientists at major organizations that are working on a vaccine or drug told times that they are pinning their hope. They were told that they were pinning their hopes on the initial evidence that the virus is stable and not likely to mutate the way influenza virus does, requiring a new vaccine every year. So they're hoping that the virus becomes stable and it doesn't it's not likely to mutate the way the influenza with the flu virus does. So in other words, that's why when you get a flu shot one year, you have to get they're giving you a different shot the next year. You don't get the same because you're going to be immune to that same, I guess you're immune, basically you're not immune, to that particular, I guess you're immune to that particular shot, but they will have to give you a different shot. Yeah, so that's what they're saying, I guess. You'll be immune, in other words, if you get the flu, you're immune to that particular shot, but you still may get the flu because you're only immune to that shot. That's why they have to give you another shot every year. They have to give you that shot every year. Okay, one scientist called this a classical case of Darwinian evolution. So I talked about him too in my class. Theory of evolution, Darwin. Only the fittest survive. So in other words, if you're not fit and you can't fight off those diseases and those infections and bacteria, you won't be able to survive. Your body has to be strong enough and fit to fight those. That's why they say your immune system. So if your immune system is not, if your immune system is not fit to survive, that's why they say you got to build that immune system up. So I've been eating plenty green, leafy veggies, trying to build my immune system up. It says if the pandemic fails to wane seasonally as the weather warms up, the study warns the virus could undergo further mutations even as research organizations prepare the first medical treatments and vaccines. So they're hoping that it doesn't, the warm weather, hoping the warm weather will be in our favor, and get rid of this virus once and for all. Without getting on top of the risk now, the effectiveness of vaccines could be limited. If the vaccines were designed based on the original version of the spike, they might not be effective against the new coronavirus strain, the study's authors warned. So in other words, if they are building a cure or vaccine for that first strain of the virus, then it ain't gonna be no good toward this second mutation or the second strain, because the second strain, because in other words, you're creating a cure or a remedy for the first strain, and it might not be effective toward this other strain of the other coronavirus. Let's see. Okay, they call it, say D614G is increasing in frequency at an alarming rate. So that's part, I think that's the virus too, indicating a fitness advantage relative to the original Wuhan strain that enables more rapid spread, the study said. So in other words, it started in Wuhan, China, but it was another strain besides the strain that came from Wuhan, China. That's what they're saying, according to the study. And that's what it says. In frequency, it says there's an increasing frequency at an alarming rate, indicating a fitness advantage relative to the original Wuhan strain. It says a strain that enables more rapid spread, the study said. Unknown is whether this mutant virus could account for regional variations in how hard COVID-19 is hitting different parts of the world more. Doctors began to independently question whether new strains of the virus could account for the differences in how it has infected, sickened, and killed people. See, doctors began to independently question whether new strains of the virus could account for the differences in how it has infected, affected, sickened, and killed people. So the different strains of the virus, it affects people differently. So that's what they're saying. They were wondering, because on the news, I know I saw it before, where they were talking about how they were wondering why it affects some people differently. But now they're coming out saying that it was a different strain of the virus. Maybe it was a stronger strain. That's why it affected, So I think one last paper. Medical experts have speculated in recent weeks that they were seeing at least two strains of the virus in the U.S., one prevalent on the East Coast and one prevalent on the West Coast, according to Wuhan. I say according to WU. I guess they're talking about Wuhan, China. The new mutation could make the virus so different from earlier strains that people who have immunity to them would not be immune to the new virus. So in other words, if they had it, the first virus, they had it, and they might not necessarily be immune because it's a new strain. They're seeing a new strain of the virus. That's why they were wondering why it was hitting certain people a different way. It was harder on some people than it was others. That is indeed the case. It could make individuals susceptible to a second infection. So that is all for the day, YouTubers. So I did a little accounting review, and then I read a little bit about this. So this, but that was some interesting information. So I want to say thanks for joining me today, and glad that you could join me today. And also, yes, I have got my, I purchased me a new iPhone, so I want to be doing me some videos on my iPhone. So I want to be, shooting some videos to see the light on his phone, but my Apple phone, yep, so I want to be getting down with some, I don't have too much on here right now, but I have my Apple, different things on my phone, so this is the charger, but I want, this is an iPhone 7, I had trouble getting in the App Store when I first purchased it, but I got everything together. Then I also have, it's everything on here. I have Siri. Let me see. That's Safari. I have, different things in iPhone 7, but so I want to say thanks for joining me today. And I hope that you will come back again to see me. And I want to get with this iPhone because I want to be, doing me some videos on here. And then I also want to be doing some videos outside, I want to be shooting some videos outside. So my new iPhone 7. Later on, I might trade in for an iPhone 11, but who knows? But thanks for joining me today. So glad you can be here with me today, class. I can call you class today because I did a little tutorial. So thanks for joining me today. Hope to see you again, back here again tomorrow, the next day, next week, next month. So glad you can join me on the Cheryl Hubbard Show. So I always try to bring you quality. I'm trying to bring quality videos, educational, informational, and all around good, all around good talk. So thanks for joining me, and I'll see you on my next video. And you all have a good one.